Hey everybody, this is Jim at SP500chart.com. It's a little after 4 o'clock on Sunday afternoon here on the East Coast. I'm taking a break from watching the Falcons 49ers game. The game's still going on. I just wanted to get this done because I get nervous watching football. I'm really like pro football. And I just started feeling a little jittery, even though the Falcons are up big in the first quarter, beginning of second quarter. If you're not a football fan, ignore everything I just said. Before we take a look at the chart, I just want to remind you that the website and the video are for educational purposes only, and nothing stated at the site or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research, and you need to make investment decisions that are suitable for your personal financial situation. I am still not a licensed financial professional, but I am still a guy who draws lines on charts. So let's take a look. Okay, just for a little bit of a broader context, we want to take a look here at the 3-day chart, which shows really the entire bull run that the markets have experienced over the last almost 4 years. We started in March of 2009, and here we are in 2013, and we're looking at almost 4 years of of really a nice move off of that low up to now 1485 and change. But what I want you to see here, and this is the interesting part to me, is that while that initial thrust up was huge, with the market going from 666 to just a little bit more than a year later, topping 1200, we then backed up, and then we got up to 1370, I believe it was. And now here we are at 1485, a year and a half later. So I just want to show you, and you can see the shape of this. It looks like to me that the moves are getting smaller and smaller. The payoff is getting less and less. Yet yet the S&P continues to just trudge higher. This red line right here is a line where I would expect some very strong resistance. This is a line that is drawn over the tops of 2000 and the top of 2007. So we extend that line on out, and here we are, about 115 points. And if you want to put that in terms of percent, roughly 8% underneath this line right here. Okay, so I'm just showing this. I'm not telling you that the S&P is going to fail here, where we sit right now, but I think it's good to see the big context of this, because actually the part of this chart that we've been honing in on lately is just this little stuff that's going on right here. So this puts that in perspective. Okay, now looking at a daily chart, we are now looking at really the last leg up, as it were, um, which really I think started in October of 2011. Here, we made that intraday panic low after this head and shoulders right here. Then we started to move up into a channel, it looks like, between this line and this line right here. Now this line is open to interpretation. All lines are open to interpretation. Matter of fact, I did not have this one drawn there for a while. For a while, I had this starting back on the top of this head and shoulders, drawn across the top of this head and shoulders. But if we make that call like that, hold on, then you can see that we violated that line here, and we're above it again. So I am going to the last two known tops, placing this particular line now about here. Okay, so if we go with the two more recent tops, we end up with what is a little bit looks a little bit more like some clear channel action. So if this is the case, um, we could be we are still in this channel, but I think this blue line right here um, should work some resistance. It just because this was drawn over that panic bottom of 2011, then the lows of late spring 2012. You can see how that broke clearly in November of 2012, and we have come up here for a couple of back tests on that line. And here we are on a 30-minute chart looking at that same blue line. Um, and it seems to me like the market needs to pull back. I would love to see a pullback to the 1440s. I don't know if we're going to get it, but I'm going to steer clear of this until we get um, until we see some weakness in the market, because this is just kind of looks to me to be a bit extended here. It looks about ripe for a pullback. So me personally, I'm going to wait. If we look at the chart in terms of our weekly review, all I can say is we kind of identified this as a support line coming into the week, and all week long, despite kind of hammering down on it a bit, um, we managed to stay above that line. I think the one kind of goofy call I made is this looked to be awful much like an ascending pennant, which would be bearish. That would make that something of a bearish formation, even though it's at the top of a chant. Excuse me, even though it did not form after a swift down move. If we'd had a 40-point down move and then a recovery that looked like this, you would normally expect that to be bearish. But instead, we had a large gap up on the first day, trading day of 2013, and then we just started melting sideways to up. I thought this would be a pennant, but the last 2 days of this past week, the S&P has showed me to be wrong. Now, I'm not going to say, as I've heard some people say, that my analysis is correct. The market just hadn't figured it out yet. No, my analysis of this trend line right here looked real good, but the market proved no, it has something else in mind. So you have to be willing to take a step back, be as objective as possible. And when you get something wrong, there's no strength and there's no value in saying, I got it right. It's the market that hadn't figured it out. Or I got it right. And it's the Fed that is bailing the market out. Or I got it right and it's QE1, QE2, QE3. You know what I'm saying? The market is the market. Now, what's interesting in all of this is the fact that by the way, we did call this little pattern right here a bear flag, but remember, we're not looking for these huge moves off of a small bear flag that forms off of a small downward move. I think that was one more call that we made this week. But anyway, what I'm trying to say is that the market is always right, even though the fundamentals, as we go forward, looking at the the things that are taking place in Washington, D.C., there's still going to be gridlock. There's still going to be problems. The difference is is that the market now seems to be quite comfortable with those economic realities. Now, I just want to say one more thing and I'll let you guys go. Drudge Report. I follow Drudge Report. Their headline on Friday showed two champagne glasses toasting each other, saying a 5 year high for stocks. When you start seeing celebration in the markets, keep a close eye on things. That's all I'm going to say. When you start seeing people feel like, oh, wow, man, this thing's going to just keep going up, folks, that's when everybody who is not savvy will plow in their last dollar. And that's when the pros will let them do just that as they sell them their shares. And and it would not surprise me one bit if we come back and we look at this chart in a few years and we see this pattern of one, two, and quite easily, we're not there yet, I'm not making the call, but it would not surprise me if we see a third top up here right around 1600. And if we see that, it will likely be those last few dollars being absorbed into the market by people who will then be hurt as the markets likely turn south. I say likely because we got this line right here to contend with. So anyway, guys, that is the video in the weekly review for the week ending January 18th, 2013. Want to thank you for watching. Want to thank you for your support. If you're a subscriber, thank you so much. If you are not, just come by sp500chart.com, see what it's all about. Hey, everybody, take care. Go Falcons.